Quoted Companies Alliance is an independent membership organisation. We champion the interests of small and mid-sized quoted companies. And effectively we do three things. We campaign, we create interaction between our members and with our members, and we inform. So we do best practice guides, and we create seminars and events, usually involving fund managers and companies, so they can learn more about each other. Potentially from next year, we will see a change to stamp duty. That's a 0.5% levy on all trading that happens across all the markets at the moment. And the government is proposing to abolish stamp duty for the trading in shares on AIM stocks. It's a very welcome move. There's going to be a consultation before that takes place, but that's on how to do it rather than whether to do it at all. The effect of this we think, is over time we will see an increase in trading. The increase in trading, the increase in share volumes, should increase the valuations of companies, which will make them more attractive when it comes to raising money. That finance will enable them to grow and create jobs. It's as simple as that. It certainly is, and allied to the announcement in the autumn statement late last year, in December last year, that AIM shares will be included in ISAs, increase the attractiveness of the AIM market for retail investors, and that should improve the liquidity in the market as well. I think AIM has a very important part to play in the UK economy. It always has done. AIM and also the ISDX market are growth markets, and it's interesting to see that the European Commission, through something called MiFID, one of the directives that they're looking at, is introducing a concept of an SME growth market. This will allow European law to be more proportionate, so that companies have a lesser burden of regulation. And again, I think that will help improve the attractiveness of AIM and also ISDX and other growth markets across Europe. And in doing so, I think it'll encourage companies to consider public equity as being a very viable form of finance going forward. So we should start to see more companies joining the market over time. As you're right, it's had a really tough time over the last few years. But there's a sense from the fund managers and also from the advisors that they're more confident about the capital markets as a whole. Well, the London Stock Exchange has announced the introduction of the high growth segment. This is for companies which are showing compound growth of their revenues of at least 20% per annum. They're looking for companies to be raising at least 30 million and with a public float of at least 10%. This is a very niche market. We won't see a huge number of companies joining this segment, but they're a very, very important segment. This is for companies, technology companies, with a market capitalisation of around 300 to 500 million. So they're already significant companies, and it's very, very important that they have access to the UK capital markets in an attractive way which is competitive with, say, the US. And so we should see some very significant companies joining this segment, and it should prove to be one where technology companies will again be able to raise money, grow, create jobs and benefit the UK economy. It's also open to other European companies from outside the UK, from the rest of Europe joining as well. Well, the key thing is, as you say, access to capital, and our most recent quarterly survey that we conduct in partnership with Accountants BDO, it's conducted by the research organisation YouGov, says that companies are typically more confident about their prospects than they have been for a long time. Confident about their prospects, confident about the UK economy as well, that's increasing. But over the 18 months that we've been doing this survey, access to finance, the confidence about that is at its lowest level. And when we talk about access to finance, that's the public equity markets, private equity, public debt and bank debt. So we have a huge concern that we need to see these sort of initiatives like AIM shares in ISAs, like the abolition of stamp duty, initiatives which provoke companies to consider the different options for finance, because if we don't have that, they will not be able to grow just at a time when the economy is turning up. And if there's a shortfall in working capital or a shortfall in long-term capital so that they can change their economic circumstances, we won't see the growth that we need in this country. They're doing something, but there's always more that they can do. And we would like to see some significant changes to capital gains tax, entrepreneurs relief, to encourage employees to own shares in their company, but also other investors to invest in growth companies. We would like to see changes there. We'd like to see a designation of small and mid-sized quoted companies as a distinctive asset class across Europe, so that the regulators and the policymakers can apply different set of rules to the smaller companies than they would to the largest Vodafones of the world, the FTSE 100. We want to see that differentiation so that the burdens are more appropriate for those growth companies. I think at the moment we can learn from the initiative in the US, the Jobs Act, which JOBS stands for Jump Starting Our Business Startups. That has set a framework for companies with revenues below $1 billion to be treated in a different way, to be encouraged and to be nurtured in a much more encouraging way than we're seeing currently in Europe. When we talk about small caps in Europe, you're probably talking about companies with a market cap below 100 million euro. If you think about the Jobs Act with revenues below $1 billion, and their definition of a small cap is below a market cap below $2 billion, there's an opportunity in Europe to expand the vision so that companies of a much larger size are treated in a more nurturing way. And I think that's an incredibly important campaign that we will be pushing for with the European Commission and in Whitehall as well.